Imagine retiring comfortably without compromising your faith free from riba and aligned with Islamic principles. If you're a Muslim or ethical investor in the USA, UK, or Europe, this is possible through Halal retirement planning. Let's dive in. Many of us dream of a secure retirement, but traditional plans often come with hidden challenges for those seeking Sharia compliance. In conventional finance, retirement accounts like 401ks in the USA, SIPPs in the UK, or similar pensions in Europe frequently invest in interest-bearing bonds or companies involved in haram activities, such as alcohol, gambling, or pork. This introduces riba interest, which is strictly prohibited in Islam, as it creates wealth without productive effort and can lead to exploitation. Additionally, inflation erodes your savings over time. If your money sits in a low-yield savings account, it might not keep up with rising costs, leaving you financially vulnerable in your later years. For example, in the USA, average inflation hovers around 2–3% annually, while in the UK and Europe, it's similar or higher post-economic shifts. Without ethical investments that combat this, your portfolio risks stagnation. The paradox is that while we avoid riba to uphold our values, we still need strategies for long-term wealth building to support our families and communities responsibly. The good news is there are practical, riba-free alternatives that focus on ethical, Shariah-compliant investing. Let's break this down step by step. First, understand the core of halal investing. It avoids riba, which is excessive uncertainty, and maisir, or gambling. Instead, it emphasizes profit sharing, asset-backed investments, and companies screened for compliance, typically those with low debt and no involvement in prohibited industries. One key solution is Shariah-compliant ETFs, which offer diversified exposure to global markets without the haram elements. For instance, in the USA, the SP Funds S&P 500 Sharia Industry Exclusions ETF, ticker SPUS, tracks large-cap U.S. companies that meet Sharia standards, focusing on tech and healthcare sectors. It has shown strong performance, helping combat inflation through equity growth. Similarly, the WATFEEDC USA Sharia ETF, or HLAL, is popular for its alignment with Islamic principles and availability on platforms like Watt Invest. In the UK, options like the iShares MSCI World Islamic UCITS ETF, known as ISWD, provide broad international exposure, including European stocks, with historical returns around 11 to 13%. For Europe, funds like the HSBC Islamic Global Equity Index Fund offer sukuk, which are Islamic bonds, and equity mixes, ensuring fixed income without interest. Another approach is halal mutual funds, such as the Amana Growth Fund in the USA, which invests in Sharia-compliant U.S. equities under strict advisory oversight. For retirement-specific vehicles, consider halal 401k plans through providers like Shariah-Portfolio, which curate compliant mutual funds for U.S. employees. In the UK, you can opt for Sharia-compliant pensions via platforms like Islamic Finance Guru, integrating ETFs into your SIPP. Europeans might explore multi-asset funds from HSBC for a balanced portfolio. Here's a real-world example. A 30-year-old in London could allocate 70% to equity ETFs like ISUS for growth and 30% to sukuk for stability, aiming for retirement by 65. This diversifies risk while staying halal. Even with these tools, beginners often stumble. One common mistake is blindly trusting halal labels without verification. Always check Sharia screening from bodies like AAOI-FI or use apps like Zoya to confirm compliance. Another is failing to diversify. Putting all your savings into one asset, like property or a single stock, exposes you to unnecessary risk. For instance, over-investing in volatile crypto without halal checks can mimic gambling. Emotional investing is a third pitfall. Buying high during market hype or selling low in panic ignores long-term strategy. Also, assuming stocks from Muslim-majority countries are automatically halal is wrong. Many involve debt or haram activities. Finally, ignoring income purification due to any incidental non-halal earnings can undermine your efforts. Avoid these by educating yourself and consulting certified advisors. Ready to start? Here's a simple plan. Step 1. Assess your goals. Calculate how much you'll need for retirement using online halal calculators, factoring in inflation and life expectancy. Step 2. Open a compliant account. In the USA, use what for a halal IRA? In the UK, HRIS, IPP via platforms like AJ Bell with halal funds. In Europe, robo-advisors like Tabadulot for automated portfolios. Step 3. Build your portfolio. Aim for 60 to 80% equities in halal ETFs like UMMA for global exposure, and 20 to 40% in SUKIK for lower risk. Diversify across sectors to manage risk. Step 4. Invest consistently. Use dollar cost averaging to buy shares monthly, which reduces timing risks. Review annually for rebalancing and purification. Step 5. Educate ongoing. Follow resources like Islamic Finance Guru or Amal Invest for updates. Remember, this is educational content, not personalized financial advice. Investments involve risk, and past performance doesn't guarantee future results. Consult a Shariah-compliant financial advisor and consider your circumstances before investing. Building a halal retirement is about patience, ethics, and smart planning, aligning your wealth with your values for a blessed future. If this helped, subscribe for more on Islamic investing. Stay committed, and may Allah bless your efforts.